All right, I'm gonna read this one to you guys today from the Insider. So this was posted on February 24th or sometime. And it says the Ukrainians and Russians are packing ATM lines, prompting fears of what happened in the U.S. during the Great Depression. Key points here. You can see this picture here. People standing in line trying to get their money. That's crazy. Ukrainians stood in long lines outside of banks and ATMs hoping to take out their funds, even defying curfew to do so. Fuck a curfew. After Russia invaded Ukraine Thursday, people in both countries started withdrawing cash from banks. It's led to fears of bank runs, which triggered turmoil in the U.S. during the Great Depression. Bank runs can lead to bankruptcy, unemployment, lending shortages, and closed businesses. This is the beginning of something that could be very, very bad overall. Many of the Ukrainians who haven't already fled the country as Russia's threat turned into invasion stood in long lines outside of banks and ATMs hoping to take out their funds. Meanwhile, in Russia, people are also queuing outside of ATMs trying to get US dollars as its citizens worry their own currency's value will continue to tank, according to the Wall Street Journal.
The dollars have run out, and what that tells you is that Russians are really frightened for their economy. They're frightened for watching the ruble plunge in value. They're going to try and get dollars, and they're not able to find them in some of the banks. And that may be an indication that President Putin is still struggling to bring his country with him on this.
Banks in the capital city of Moscow are running out of money, and that cannot be a good thing. All of this has led to fears of bank runs, which is when people withdraw money in masses because they worry banks will cease to function. You got to think about it. Like, if you have a fair amount of money in your bank, but let's just say you see the trend of everyone else withdrawing their funds from your bank, that could run your bank dry. I'm not 100% sure if the banks in Ukraine and Russia are FDIC insured, probably not, or have any sort of insurance like we do here in the US. So if the bank runs out of money, that means you could have run out of money. Or maybe even if they run out of money, but then you still have a balance, but you can't access it. I mean, this is as good as gone. It has the potential to be a self-fulfilling prophecy, destabilizing banks to the point of bankruptcy. That's what happened in the United States during the Great Depression, and it triggered mass unemployment and loan scarcities. In fact, what took place in the U.S. between 1929 and 1938 serves as a case study of what can happen when banks can't keep up with withdrawals. For years to come, there could be less money to go around. Locations around the country that have more bank failures have larger declines in spending, according to David Wheelock, the Senior Vice President and Special Policy Advisor to the President at the Federal Reserve Bank of St. Louis. He said during a workshop examining the Depression in 2013, simply put, he said, people lose money, they spend less. So that's just going to ultimately hurt the overall economy. Ukraine and Russia have taken steps to avoid bank runs. Banks in Ukraine are attempting to quell the possibility of economic havoc by imposing limits on withdrawals. Well, we all know as people, placing limits is not a good thing. We don't like that. We tend to push back, and that can cause some serious unrest and unnecessary chaos and panic on top of this already challenging crisis that these guys are faced with, the invasion. I think I'm saying this correctly. Donetsk Republic in eastern Ukraine limited withdrawals this week to 10,000 rubles, roughly $120 per day from ATMs. The National Bank of Ukraine also employed a cash withdrawal limit of 100,000 Ukrainian hryvnia per day. I know I'm butchering that on Thursday, or about $3,339, also halting exchanges for Ukrainians trying to obtain foreign currencies. To avoid catastrophe in its own country, Russia's central bank announced an emergency support package on Thursday as its stock markets plunged in response to the government's military action. No shock there. That package includes closing the stock exchange and purchasing millions of rupees to increase the value of the currency. The central bank has not yet imposed restrictions on how much cash people can withdraw, which is a good thing. European Commission Chief Ursula von der Leyen said that although Russia is currently withstanding the impact of its shrinking currency and impending sanctions, additional interventions could weaken Russia's economic base and its capacity to modernize. The Great Depression is a cautionary tale. After the stock market crash of October 1929, anxious Americans withdrew massive deposits of cash, which frequently forced banks to permanently close according to history. Because banks only physically carry a limited amount of cash at any given time, sudden bank runs like the ones that spiraled through the country in the 1930s forced banks to sell their assets to acquire the cash to give people when they requested it, leading to bankruptcy. The impact of such bankruptcies varied through the U.S. according to the Federal Reserve Bank of St. Louis, but it often had ripple effects on the rest of the economy. Hundreds of banks failed, lending declined, businesses faltered, and unemployment rose. The crisis also generated deflation because they convinced bankers to accumulate reserves and the public to hoard cash. A decline in deposits meant that the banks had less money to lend out, which meant that people had less money to pay for goods and services, and that the prices of those goods and services deflated. According to the Fed, that deflation further forced banks, businesses, and debtors into bankruptcy, reduced consumption, and ultimately increased unemployment. Think of the financial system that keeps the whole wheels of the economy spinning. Bank failure is like throwing sand into the wheel, or even chopping off bits of the wheel altogether. Now, I don't know about sand. This feels like you're throwing a stick through the spokes of a bicycle tire and just going to cause the whole thing just to crash. And, I was actually asked the other day, do I anticipate a housing market crash? And, my response to that was we would have to have some form of huge impact on the amount of money available to the people to initiate a housing market crash. It would be a byproduct. I don't think the housing market itself is going to cause a crash. I think that there would have to be some sort of outside force, additional factor to prevent the amount of money available to people to force the housing market crash. Just like this article is saying here, people hoarding cash or banks declining in the amount that they can lend or even being able to lend at all is ultimately going to deflate the value, deflate the price of goods and services, ultimately causing a recession and people wanting to hold on to the money that they have because they can't get any more. Whether they can't get any more cash, it's actually theirs, or if they can't get any more or can't get access to funds through loans, they're just, it could cause that ripple downward spiral crash that everybody's anticipating. But I don't think it's just because buyers are tired of buying homes at higher prices or, the market can't sustain it. I don't think that's the case because the supply of housing is drastically lower than the demand for housing. So I don't want to get off into a completely different topic, but this has indications to me of what could cause that crash. Now, granted, this is the Ukraine and Russia, but if we were to see something like that happen here, these are signs. This is we're basing futures. We're making projections of what could happen based on history. What happened before, history often repeats itself. So, food for thought. Take that into consideration. Hit me up in the comments. Let me know what you think, and I'll be back very soon with another update. Thanks.